All right, let's get right into it. Today, we're unpacking an exclusive macro briefing that completely deconstructs the mainstream financial narrative. We're pulling back the curtain on some serious, hidden structural risks in today's economy, specifically drawing on the latest special service newsletter from the Macro Butler titled The AI Inflation Invoice. There is just a massive disconnect right now between what the headlines are screaming and what the underlying math is quietly doing in the background.
So here's the roadmap for today's explainer. First, the inflation illusion. Then, we'll hit the core CPI reality, market miscalculations, the AI inflation invoice, and finally, preparing for wave 2.
Starting with Section 1, the inflation illusion, or what we're calling a temporary smoke break.
Let's start with these surface-level numbers that frankly had Wall Street popping champagne way too early. The source material actually describes our current economic moment perfectly. It calls it the interlude of Act 2 of Inflation Wave 2. Right now, we're in this pleasant little pause where commentators are mistakenly declaring the inflation concert completely over. The orchestra's catching its breath, the conductor is loosening his bow tie, and everyone thinks it's time to head home. But trust me, it isn't.
The sixth CPI print of the year arrived with a surprisingly tasty negative 0.4% month-over-month drop. Energy prices decelerated sharply, but, as the briefing points out, this number was largely cooked up during a Middle East ceasefire that has since expired. It took that temporary energy price calm right along with it. The underlying tensions in the supply chain, they haven't vanished at all, they're just backstage. When we contrast the euphoric tone of the market with actual macro reality, it is staggering. The mainstream narrative is loudly declaring mission accomplished, but the macro reality reveals this was just a temporary smoke break. The cigarette was literally just stubbed out on the pavement. The underlying drivers, like energy spikes and supply chain chaos, are notoriously late risers. They haven't shown up in the data yet, but for sure they will.
Moving on to Section 2, the core CPI reality, the stubborn math.
Let's look beneath the tip of the iceberg here. Cue the triumphant return of everyone's favorite zombie metric, owner's equivalent rent, or OER. Now, this is the theoretical rent you charge yourself for your own house, and it held steady at a dignified positive 3.3% year over year. Policymakers are celebrating this just because it didn't accelerate. But the zombie is still walking, right? It continues to drain household purchasing power like a slow puncture in a life raft, and merely stabilizing at this high level is absolutely not the victory it's being packaged as.
Following right behind that is supercore CPI, core services excluding housing. The Fed spent 2 years calling this the purest signal of price pressure. Well, it recently decelerated to 3.17%. The consensus celebrated this, but as the briefing notes, they did so with the enthusiasm of a guy noting his house is only moderately on fire. It stubbornly parks itself above 3%, completely refusing to return to that magical 2% target.
So the crucial point comes down to elementary school arithmetic. For the Fed to actually hit their miraculous 2% inflation target by year end, we would literally need monthly CPI prints of exactly 0.0% from here onward. That is a total statistical fantasy in a world of geopolitical conflict and volatile energy markets. No way that happens. If CPI keeps printing at a far more realistic 0.2% or 0.3% month over month, the destination isn't price stability at all. As the projections show, we are looking at somewhere between 4.3% and 6.2% inflation by December. The math simply does not support the optimistic narrative being sold to the public. Which brings us to Section 3, market miscalculations, pricing in the impossible. The market reactions were incredibly telling. We saw the US dollar index weaken in a knee-jerk reaction on disinflation hopes, only to immediately bounce back as the market remembered, oh right, the world is still an unpredictable geopolitical neighborhood. Meanwhile, gold held incredibly steady, retesting the $4,000 mark intraday. Gold remains the ultimate anti-fragile asset for moments involving active wars, compounding sovereign debt, and, frankly, fading institutional credibility. Meanwhile, Wall Street took a deeply flawed victory lap. Equities closed in the green, treasuries rallied, and the market priced in a 66% probability of a rate hike in September. They completely shrugged off stagflation warnings, rewarding a central bank that spent 2 years driving the inflation bus in the wrong direction and is now arriving fashionably late to the tightening party. Okay, Section 4, the AI inflation invoice, the hidden costs. Now, what's really fascinating is how the booming tech sector directly plays into this next wave of inflation. We've all been sold a story that artificial intelligence is this deflationary miracle, right? Cheaper code, cheaper cognition, infinite thinking at zero cost. But as the newsletter points out, the wise investors actually read the electricity bill. AI does not abolish scarcity, it relocates it. It moves scarcity from the things machines make directly to the raw, physical things that machines need to run.
Think of the AI economy like a 5-layer cake. The top layer is the icing everyone sees and Instagrams, the slick applications and chatbots. But below that are the models, the compute, the infrastructure. And at the very bottom, holding the entire cake up, is raw energy. Everything above layer 1 is quite literally just electricity wearing a costume. You simply cannot disrupt thermodynamics with a term sheet. So physical cost of this intelligence is massive. Every single time a chatbot thinks, it spends power, water, and copper. When a hyperscaler builds a massive data center, they are placing a multi-gigawatt bid on the foundational commodities of human civilization. Thinking might be getting cheaper, but power, water, and memory are getting violently and durably more expensive. This quote from the briefing perfectly captures the dynamic. When the giant and the gardener draw from the same well, it is never the giant who goes thirsty. These massive tech giants are drawing from the exact same pool of energy and water as the average household down the road. But there's only one clearing price. This massive industrial demand drives up costs that inevitably seep into the foundation of everything everyday consumers buy.
Finally, Section 5, preparing for Wave 2, the elite strategy.
Inflation didn't die. It literally just stopped to tie its shoes. It's lacing up for Wave 2. As the U.S. Umbrella Inflation Index shows, collapsing institutional trust and rising prices move together like synchronized swimmers in a controlled demolition. The louder the official narrative insists things are stable and well-anchored, the more households actually feel the very real squeeze at the checkout, the petrol pump, and the utility meter. The spreadsheet hopium of Wall Street won't protect you from the physical realities of the AI inflation invoice. To navigate these structural risks and partner with the definitive source for elite analysis, contact the Macro Butler directly at info@themacrobutler.com and visit themacrobutler.com. When the giant and the gardener draw from the same well, whose thirst will your portfolio be prepared to quench?